Hi there, I'm Arben Skivjani, Deputy Chief Economist and Director of Forecasting here at RealPage, and one of the hosts of Multifamily Talks, a RealPage podcast. Our today's guest is an influential expert in real estate, offering analysis, commentary, and forecasts on trends in the U.S. housing and mortgage markets. She's a 2023 woman of influence, an incredible economist who initially wanted to become an astrophysicist, but the invisible hand of Adam Smith pushed her towards the field of the dismal science. Odeta Kushi is the Deputy Chief Economist at the First American Financial Corporation, a financial services company which provides title insurance and settlement services to the real estate and mortgage industries. Now, for about 45 minutes or so, we discussed a number of issues surrounding the single housing market, as well as the economy in general. I hope you find our conversation insightful and amusing. All right. Good afternoon, Odeta, and thank you for being with us here today.
It's a pleasure to be here. Thanks for having me.
Oh, it's fantastic to have this chance to virtually sit down with you, especially since I'm used to seeing your expert commentary on CNBC, Yahoo Finance, and Bloomberg TV discussing housing trends. And we have a wealth of topics to explore today in the housing industry, including inflation, mortgage rates, GDP, Fed's decision, you name them. But first things first. I've got to throw some major congratulations your way. Recently, Housing Wire, a major name in the real estate industry, has named you as a 2023 Woman of Influence, a well-deserved recognition.
Thank you so much. I really appreciate it.
Absolutely. And for those in our audience who might not be familiar with the accolade, could you share a bit about what it represents and what it means to you personally to receive such an accolade? And as an Albanian American, myself, I must say, seeing you achieve this makes me incredibly proud of our shared heritage. It's truly inspiring.
Well, thank you so much. Your words mean a lot, and so did the award. You know, our small but mighty economics team here at First American puts a lot of work and passion into creating the analysis that we do. We really try to think about what would be valuable to our listeners, to real estate professionals, to potential home buyers, to investors, really everyone in sort of the real estate ecosystem. And so we put a lot of passion and data and econometrics and blood, sweat, and tears into that analysis. And so to be recognized for that work means a lot. And certainly to be recognized with all of the other women that were named Women of the Year in Housing Wire's 2023 version. You know, it's an honor to be named alongside those women as well. So, yeah, thank you.
And again, congratulations once more on that remarkable achievement. And I'm confident that it's not going to be the last one, right? But now I think it would be wonderful to start with your story. I mean, could you share with us how it all started and what sparked your passion for economics, more specifically for real estate economics, then led you to your current role as a Deputy Chief Economist at the First American? I mean, we'd love to hear about the moments or people that inspired you along the way.
Sure. You know, so the story really starts with the fact that economics, I think, is so deeply intertwined with so many other disciplines. You know, you need to know math, you need to know some statistics, and history is helpful, of course. So the fact that it's an intersection of all of those disciplines is really what drove me towards a career in economics, because I enjoyed all of those disciplines, right? Particularly statistics. And so I think that my academic interests really led me down the path of majoring in economics in undergraduate and graduate school. But then once I was in a graduate school, I really focused a lot of my research on economic growth and the drivers of economic growth. So specifically, I looked at privatization as a driver of economic growth. That was really inspired by a book I read by economist Hernando de Soto. It's called The Mystery of Capital. I don't know if you've had a chance to read it, but it explains how, you know, rule of law and title to property and secure property rights are so essential to economic growth. So, you know, couple that with my background from Albania and kind of seeing a country go from a more isolated economy to a very fragile free market, open economy. I think trying to understand what drives growth is what got me interested in private property and then ultimately in real estate. Of course, once I started my job here, my boss at First American, our chief economist, has been a major inspiration. He's been, he's really central to the real estate economics world, and so I've learned a lot from him along the way as well.
We always do need those mentors, don't we?
Yes, absolutely. They're crucial.
Absolutely. And then it's fascinating how, regardless of how long we've been immersed in our careers, there's always that one thing that fuels our drive and gets us excited to start each day. Now, in your case, as a real estate economist, I can imagine there's a strong passion behind your work. So what is that keeps you so engaged and so motivated in your field? I mean, what makes your work meaningful to you?
Well, housing is a basic necessity. And so its availability and affordability and quality have very important social and economic implications. And so as a real estate economist, I'm able to study all of the different factors that influence housing supply and demand dynamics, homeownership, demographic trends, rental markets, and of course, the impact of housing policies on households and communities. I think on a personal note, being an immigrant in this country, I was no stranger to the concept of the American dream, which is heavily intertwined with the dream of homeownership. And so I think being able to study and make research available to the public about homeownership trends is really important. I think drives the research that we do. Just recently, our team put together an analysis on the 2022 survey of consumer finances. We've been waiting patiently. This data set comes out every 3 years, so there was no set date, and then it finally got released, and it really gives us some insight into the breakdown of net worth by renters and homeowners. And that data confirmed once again that the median homeowner has about 38 times the household wealth of a renter. So I think homeownership as a primary driver of wealth creation in this country is another motivator for why we study this topic and want to inform potential home buyers about what's going on in the market.
Absolutely. And speaking of Albania and those parts of the world, a couple of years ago, Jay Parsons, our chief economist and our great friend, asked me something that it's been on my mind ever since. He was curious about the noticeable number of us from the Balkans region in the field of economics, including you, Selma Hepp, a great economist at CoreLogic, and myself here at RealPage. So it's a simple question, but honestly, I didn't have a straightforward answer at the time. So I'm really interested to hear your thoughts on this. I mean, why do you think so many of us from the Balkans are drawn to economics?
That's such an interesting observation. First of all, I'm a big fan of everyone you just mentioned. Jay and Selma are both doing incredible work. And I'm not
excluding me.
Not you, though. Just those two. No, really, everyone, is just doing such incredible work. And I'm not sure that I have a perfect answer either, but I will say that, again, the immigration from Albania allowed us to maybe focus on the dichotomies between maybe transitional economies and long established economies like the US and maybe, had us ask the question, what's driving these differences? And real estate is such a dynamic industry. So if you're someone who's interested in labor or demographics or, whatever it may be, subdisciplines within economics, real estate sort of brings all of those things together because there's no way you can talk about supply and demand dynamics in the housing market without studying demographics or without understanding what's happening in the labor market or with monetary policy. So I think, maybe it's just attracting these brilliant minds because it's so dynamic and interesting, right?
Absolutely. I mean, same in Kosovo, Albania. I mean, real estate data was inexistent.
Exactly.
I mean, you could learn about, how the GDP is doing, but you could never find numbers about, how many houses got sold or how many apartments were rented during a certain period of time.
Exactly. And I still ask those questions every time I travel home. I'm looking for that data and it's not readily available. And we're so lucky in this country that we do have that data at our fingertips and we can learn and extrapolate trends. So that's a really great point.
Well, we'll have more time later on for some more personal questions. But for now, let's dive into your area of expertise, real estate, particularly single-family house. I mean, could you give us a detailed overview of the current trends in single-family housing. And also, it would be really helpful if you could compare these trends, so single-family trends, with what we are seeing in multifamily housing sector. Even though you are not as much involved in multi-housing, I'm going to put you right on the spot.
Let's go. Let's do it. Yeah, I mean, it's been a whirlwind, I think, in the housing market. As you well know, we've definitely been up the roller coaster, and certainly we've been down the roller coaster in the last year. Double-digit house price growth, the frenzy of the housing market of 2020 to 2022, multiple offer bidding wars resulting in double-digit house price growth, lowest days on market in the history of record keeping. It was really sort of a perfect storm of supply and demand dynamics in that pandemic housing market. You had millennials aging into their prime home buying years. The bulk of millennials were turning 30 around that time period. And so they were out there looking for that first home. And then, of course, supply. We've been undersupplied in the housing market for over a decade, and then mortgage rates hit below 3%, really juicing the demand side of the equation. And so, again, a perfect storm of increasing demand against limited supply, which is Econ 101 for house price growth. And then on the other side of it, we had mortgage rates then increase as a result of monetary tightening, and it wasn't just the mortgage rates increasing, it was the pace at which they increased, right? Because in the beginning, people were saying, well, 6 to 7%, that's in line with historical averages. Yeah, but we went from 3 to 6 in a very short period of time. And so it's really the rate of change that really impacted people. And then people had to sort of go through the stages of grief, had to accept, denial, all those stages to really come to terms with the fact that we're in this new mortgage rate reality, I think, where rates are not going to be 3% anymore. And how do we sort of adjust to that? On the existing home side of the market, the fact that a bunch of homeowners locked into rates below 3% is sort of coming back to haunt us at this point, because traditionally existing home inventory has made up about 90% of overall inventory. And now that existing homeowners just aren't selling, that means we've really locked away a bunch of inventory in the market. And that's some sort of keeping some upward pressure on house prices, even though mortgage rates are still high. So
Absolutely.
That rate lock-in effect is really powerful, and it's allowing the new home market to sort of take up market share at this point.
I mean, what would I sell my home at my, let's say, current rate 3%, and buy another home and then pay 7% mortgage rate?
Exactly.
And I think that's what's holding back this housing market the most.
It really is, and it's builders are sort of benefiting from this, right? Because if there's no existing homes available for sale, why not buy a new home, where builders are offering rate buy downs and upgrades on quality features in the home. And so we're starting to see that. Well, we're not starting to see, we have seen that the new home side of the market has really outperformed relative to the existing home market.
Mm-hmm, mm-hmm. Now, it wouldn't be an overstatement to say that the housing market, the housing industry in general, is the backbone of the American economy. And also the U.S. housing market is so diverse and varied. So could you highlight some specific regional market trends or challenges and explain what is driving those differences?
Yeah, absolutely. And maybe I'll loop in the multifamily side as well, because I do recall that you specifically asked me to do that, and I conveniently just blew right past that part of the question. But there's obviously real estate is local, and that goes for both the single family and the multifamily side. We can generally agree that the housing market is underbuilt. So we talk about multifamily having a record number of units under construction, and that will put some downward
over
pressure.
1 million.
Yeah, over 1 million. That'll put some downward pressure on rents. In fact, it already is. You would know better than me, but I think a lot of that downward pressure is sort of appearing more in Sunbelt markets, more than anywhere. And that actually is similar, not on the supply side, but similar to what we're seeing on the single family side, where a lot of the downward pressure on house prices was concentrated in markets that were really popular over the pandemic. So you had, the Phoenixes of the world. Austin is one of the markets that appears on our negative house price growth right now, which right now
rent-wise as well.
Rent-wise as well, right? And then your traditionally more expensive markets in California and Seattle also face some downward pressure on house prices earlier this year. Things have sort of changed where we're seeing broad-based reacceleration in house prices in the housing market right now. Like I mentioned, really Portland and Austin are the only two markets that we're seeing on our list with negative price growth. And it's modest negative price growth. We're not seeing any major collapses. But everywhere else in our top 50 markets list, we're seeing a reacceleration in house price growth because, again, yes, demand has pulled back due to affordability concerns, but demand is still outweighing supply, and that's keeping the pressure on house prices.
And I agree with you. Now, let's discuss a topic that is sort of indirectly influenced by inflation, mortgage rates. And then, of course, it affects housing industry tremendously. Now, after hitting 8% back in October, maybe a little bit more than that, the average rate for 30-year fixed rate has been coming down quite a bit. Currently sitting at a little under 7%, around that. So now, not great, but still much better than where it was not too long ago, just 3-4 months ago. So where do you see the rates going in the next, let's say, 6 to 12 months? For those contemplating homeownership or refinancing, how do these changes impact their decisions and the overall housing market dynamics? Because I'm sure these rent changes are going to have a tremendous impact on the housing market.
Absolutely. I think buyers and sellers are incredibly rate sensitive, particularly in today's market. Forecasting mortgage rates is notoriously difficult, as you previously mentioned.
Forecasting, it's easy.
It's easy, exactly. If I knew what mortgage rates were going to be at the end of next year, that would be really, really great. But I think at least we can sort of talk about how to think about it, right? Which is mortgage rates are not directly tied to the federal funds rate, as you mentioned, but they are sort of indirectly influenced. They're loosely benchmarked to the 10-year Treasury yield. And the reason we say that mortgage rates are tough to forecast is because everything impacts that 10-year Treasury yield, the long end of the yield curve. Wars can impact that long end of the yield curve. Any sort of uncertainty that makes people sort of flock to the safety of U.S. Treasury bonds, can impact that long end of the yield curve. But one of the main factors that's been impacting it is inflation and inflation expectations specifically. So when inflation and inflation expectations are high, that yield goes up, mortgage rates go up, and vice versa. To your point, just this morning I checked, the 10-year Treasury was below 4. So So assuming, it is assuming that the spread, which has been about, 290 basis points more elevated than usual, we're in the 6 percentages for mortgage rates, high 6s, but 6s nonetheless. So we'll take that win. In terms of what we see next year, the Fed sort of provided us some certainty. They've so much as told us that we've hit the terminal rate. And so that certainty should allow that spread to come down a little bit. I don't think that it will come down to historic norms, which is around 170 to 200 basis points. I think it'll still remain elevated because of all the duration risk in the market, but it'll come down a little bit and should allow mortgage rates to settle down. The consensus in the industry is in the 6s. I wouldn't be surprised if we got to a 6.5 mortgage rate, barring any unforeseen circumstances. I've got to give my caveats. But I wouldn't be surprised if we saw, mortgage rates in the 6s next year, which should help the affordability equation a little bit.
So are you telling us indirectly that we should forget about 4%, even 5% interest rates in the short run or midterm?
I'm going to eliminate the 4% scenario. I'm not so confident on the 5s.
Absolutely. I think it'll be around 5%. But I think this is a good time to talk a little bit about our friends at the Fed. So yes. when discussing housing, the Federal Reserve's decisions are always pivotal. And in its latest meeting, the Fed opted to maintain the federal funds rate at where they are, 5.25 to 5.5% range, while also hinting at potential rate cuts. We haven't heard that word in a while, in decades, next year. So possibly 3 of them. what's your perspective on this decision? And then when do you think we might start seeing these rates come into effect?
Yeah, so the Powell pivot that we've all been waiting for finally came in December, which is great. The markets have maybe taken that information and run with it. I checked this morning; they're anticipating like 6. Powell's like 3, and the markets are thinking 6 rate
Keep
cuts
on
next
dreaming.
year. Keep on dreaming, exactly. But in that sense, the bond market's sort of loosening credit conditions, right, in their own way. But I think the Fed's going to be patient. They really want to avoid a 1970s scenario where maybe they prematurely stop their tightening and allows inflation to reaccelerate. And so, I'm thinking maybe rate cuts in the second half of next year. Really, they'll only cut rates if inflation has made significant progress towards 2%, or they think that without rate cuts, we'll head towards a recession. Right now, the soft landing scenario is looking pretty plausible. The labor market's been showing remarkable strength. The consumer's been showing remarkable strength. So, that's still the fingers crossed option, is that soft landing scenario, but I think the Fed will be cautious.
So you're telling me that the softening of the recession, of inflation, is not transitory now? Like
it's not. Right. It's not transitory. Oh man, we were saying that word a lot.
Absolutely. In addition to the federal funds rate, both employment and GDP are vital economic indicators that significantly affect the housing market, both multifamily as well as single family. Now, while employment growth has been slowing down lately, about 200,000 jobs created in November. Last quarter, GDP grew a pretty robust rate, regardless of why it grew and how it grew. It's pretty robust, about 5.2%. Now, can you explain how changes in both employment and GDP impact the housing market, single housing market, particularly in terms of consumer confidence and buying power?
Yeah. So, buying a house is probably the single biggest investment that you'll make, and consumers don't do that lightly. And so that's one part of the conversation that I find is often missing when we talk about the health of the housing market. We talk about mortgage rates, we talk about house prices, but we don't always talk about how the consumer's feeling. If you're not sure that you're going to have your job in 6 months, you're not going to buy a house. It's just not going to happen. It's too big of a risk. And so I think expectations on the health of the economy are incredibly important. I often say that, sentiment turns to sediment. So, if the sentiment is negative, I think that could really bake itself into the economy. 70% of our GDP growth is based on consumer spending. If consumers are not feeling confident in their job, if their wages aren't growing, then they won't spend. That's not a problem we've had to deal with as much in this economy. Consumer spending is really strong, particularly in sort of services spending. We've pivoted away from the goods spending, all of the Pelotons we bought over the pandemic and all the stuff we bought for in the home has now shifted to travel and, spending on salons and things like that. So that's still going strong, in part because of the excess savings cushion, I think, that consumers built up over the pandemic. But estimates are showing that cushion is sort of deflating. And so that could weigh on consumer spending next year.
Excellent. And in my opinion, consumer sentiment or confidence is more about perception than reality. Mm-hmm. If you are feeling good about, what's going around you, what's going on around you, even if you have $2 in your pocket, especially us as Albanians, you feel good, you go borrow another $1 million and you buy a house, whatever. Right. But if you're not feeling good about, what's going on, even if you have $1 million in your bank, you're not going to spend a dime.
Exactly.
So I agree with you. Consumer confidence is pretty much everything. Now, since we're talking about indicators that drive our industry, both single family and multifamily, demographic changes are a powerful force in shaping housing markets. That's right. How are various demographic groups, such as millennials or baby boomers, influencing housing demand and preferences?
This is my favorite question because I've probably mentioned demographics 5 times already, and we haven't even talked about demographics. So
We have plenty of time.
Exactly. Well, it impacts, you study multifamily markets a lot. I study single family, and it impacts both, right? It's such a big driver of demand and supply as well. So we've been studying millennials for years. 2015 rolled around, and we were out there saying that millennials are going to be a driving force of demand in the housing market, even as a lot of folks out there were saying millennials are the forever renter generation. They're the avocado toast generation. They're not going to buy any homes. They're not interested. And we were saying, wait a minute, the data's showing us that there's all these factors that are highly correlated with becoming a homeowner, getting married, having kids. And millennials are doing this in their early to mid 30s. They're not doing it in their mid to late 20s like previous generations were doing it. So if our hunch is correct, millennials will become homeowners, but they're just going to do it much later in life. So just be patient. We'll start to see that millennial demand really trickle in. And luckily that sort of turned out to be the case. I think we've got about an over 50% homeownership rate for millennials, and we're still working our way through this big demographic wave of millennials aging into their 30s. So there's still robust demand from this generation for several years to come. And now our attention has sort of turned to baby boomers, because millennials are the largest living generation, but just below them are the baby boomers. And they're sort of entering their aging out of homeownership phase. The number of people 80 years of age or older is expected to more than double between 2022 and 2040, going from about 13 million to 28 million. So as the baby boomers age into their 80s and starting in the late 2020s into the 2030s, we'll start to see supply enter the market, and in very desirable metropolitan areas, right? Baby boomers have these homes in, Washington, D.C. and in San Diego and New York City. And so we'll start to see that supply flow in, though those homes will need some work, right?
Absolutely. I mean, homes always do need work. I think this is a good time to talk about another topic, and it has consistently been making headlines and justifiably so. Affordability, right? I mean, all of us want to buy a home, but it's undoubtedly one of the most critical issues in the housing market, both multifamily and single family. So what do you identify as the primary challenge in making housing more accessible to the average American, and what potential solutions or policy changes might assist in addressing these challenges? Because in multifamily, rent control is not the answer, right? We know that. So since we're talking about single family, rent control is not an issue there,
right? Rent control is not an issue, but we have plenty of other issues in the way of zoning, in the way of burdensome regulations that make it difficult to build, more expensive to build, takes more time to build. So as you can see by my answer, I think my solution is supply. Sustainable solution. There's been proposals on helping the demand side of the equation, and that's fine. But I think if you want a sustainable solution to affordability, you have to attack the source of the problem, and that's that we just don't have enough homes available for sale. If we did, we'd have a much more balanced market, resulting in house price growth that's sort of in line with historical averages, about 3%. And so I think what we need to tackle is making it easier to build and more cost effective to build, and sort of tackling that issue. Because affordability, to your point, it's never been, affordability is at its lowest it's been and since we've been measuring it. And that's a function of the fact that mortgage rates are higher. It's a function of the fact that house price growth is still positive. So house prices are still, at record highs. And we have seen incomes grow, but it just hasn't been enough to offset those two other factors, house price growth and mortgage rates. It's mitigated some of the impact on affordability, but it hasn't really, solved for the affordability issue. So I think we need to tackle supply.
And what about loosening up a little bit government regulations? I mean, I read a report recently that almost 30% of the total cost of building a home is attributed to government regulations. That's insane.
Yes, I think that might be an NAHB study. I think that they do that from time to time. It's a really impactful study, and the problem is, I think, that it's not just at the national level. It's usually down to the local level. So it's really hard to tackle. And there are some issues, lot size requirements, delays in permitting and things like that I think might be somewhat universal, but it's regulations at all levels of government that needs to be addressed.
Absolutely. I mean, we all need government, but I think government could also play a pretty big role when it comes to making housing more affordable. Not by making more regulations, but getting rid of some of the regulations that don't make sense anymore. Just my opinion. Now, I'd like to shift our discussion to another aspect of housing now. In recent years, there's been a remarkable boom in the popularity of BTRs, built-to-rent units, and transforming them into a major industry worth billions. No doubt this significant rise in single-family rentals is having various impacts, right? Not just on a specific segment, but on the entire housing market. Could you discuss the broader implications of the BTR surge on the housing market as a whole? I mean, in your view, is this trend likely to continue, or are there factors that might drive this trajectory downward?
Yeah, it's interesting because the BTR market has sort of filled a gap, right? We've talked a lot about the housing shortage, the single family housing shortage, and I think that's resulted in the popularity of build to rent because it sort of fills that supply gap in the housing industry. And so for that reason, I think that certainly there is room for growth. But they've also been a victim of tighter financial conditions, right? So we have seen that the single family built for rent construction has cooled as investor interest has sort of pulled back due to tighter financial conditions. But I think broadly the fundamentals are supportive of growth in the industry because of course, the lack.
So, now, you analyze housing data every day, and I bet you even on the weekends and during holidays.
It's a passion. Doesn't stop.
Absolutely. Now, when examining the single-family housing market, what are the key trends that currently stand out to you? I mean, I'm keen to understand the various developments and the shifts occurring in the sector, from changes in buyer preferences to architectural innovations or shifts in the overall market landscape. I mean, your insights will be helpful here.
Yeah. So, over the pandemic, we talked a lot about a shift to the suburbs, right? And that was not just in residential, but there was a lot of talk in commercial. We started to see, prices accelerate in the suburbs for office and retail, multifamily, and of course in single family residential as well. So I always like to talk about these migration trends because I think this was a trend that preceded the pandemic. The move in the single family residential market to the suburbs was a move that happened prior to the pandemic. It was your millennials, again, aging into their prime home buying years, getting married, having kids, looking for the white picket fence in the suburbs and the good schools. So this was a trend that preceded the pandemic, but was, of course, accelerated by the pandemic, the need for more space, the untethering from our home life and our office life. And so we start to see a big shift in the suburbs. So the big question has been is that sustainable? And I think over the near term, it is. I still think that there's room for growth in the suburbs because of the underlying demographic trends, but I don't think it's necessarily mutually exclusive with growth in the urban core. There's still a generation behind the millennials, Gen Z, who will likely sort of follow in their footsteps, still have an interest in living in the big city and experiencing all the amenities that the big city has to offer. And so, not necessarily mutually exclusive, but certainly the suburbs and that shift to the suburbs is something that we're seeing in the data.
Absolutely. So more people are gravitating towards the hustle and bustle of urban life, or is there a growing preference for tranquility and space of urban areas?
I think that the exurbs and suburbs are maintaining their popularity right now, but it has a lot to do with the fact that this generation, my generation, is so large, and those are sort of the preferences right now.
Absolutely. Okay. Well, I think you would agree that discussing the housing market without addressing its financial dimension is incomplete.
That's right.
Right. And as the financial side of housing continues to evolve, how do you envision the landscape of housing finance changing in the coming years, particularly in the light of different technological innovations and shifts in the economy in general?
Well, so generally, automation, right? The home buying process can still be quite cumbersome, paper intensive, and we know that the millennial generation, certainly Gen Z, is used to doing everything with on their phones and as
Tell
quickly
me
as
about it.
possible. And and so I think that at least in terms of the home buying process, there's a lot of room for, and certainly a lot of companies sort of filling that gap in terms of automation and making that process more efficient.
Now, in today's volatile economic climate, the rent versus buy decision is more complex. I mean, you hear that issue every day. Should I buy or should I rent?
That's
and
right.
If I decide, is it better to go in south, north, or where? So what factors should individuals should consider when making this decision, and how might these factors vary for different demographics? Because they're not going to be the same for different age groups.
That's right. So typically the way people look at the rent versus own decision is they just look at, well, what is the cost to rent in a given market? And then what is the cost of the principal and interest to buy a home in that market? We have an analysis where we take it one step further, which is on the own side, we actually account for appreciation in that market. So we take sort of the average appreciation in that market. And if it's positive, then we add that we basically remove that as a cost of owning. And if it's a negative growth in that market, then we add that to the cost of owning. And so it's sort of an appreciation adjusted monthly cost to own to make sure that we're accounting for the equity benefit in home owning versus renting. And when we do that, we find that despite the fact that it's a mortgage rates are higher and house prices are higher, there are still some markets where it makes more sense to own versus rent, simply because you have that benefit of equity appreciation. And I think that can sort of be forgotten sometimes, is that is the benefit of owning a home, is you get to get that appreciation benefit.
Can you name some of those markets?
Yeah,
where
absolutely.
It would make more sense to buy than rent?
Yes. So we in our last report, I believe it was Pittsburgh was one of the markets. Buffalo was one of the markets. So markets that have had good growth, but also are relatively more affordable on a relative basis.
So Dallas is not on the list.
I'd have to check for you.
Good, because I don't want to sell my home. All right. So looking ahead, and what is your short-term prediction for housing market? I mean, what trends should potential buyers, sellers, as well as investors be particularly attentive to in the coming months? And also, let's talk about long-term forecast. I mean, what is your long-term outlook for the housing market over the next decade? And what key factors do you think will shape its trajectory? A lot happening, and I'm sure a lot is going to happen between now and 10 years.
That's right. Yeah, 10 years is a long outlook, and you'd have
5 years probably good enough.
5 years is good. Okay, got me off the hook. So the near term forecast, I think, is not too hot, not too cold, but not quite right. I think we had our very cold housing market in 2023, where everything sort of came to a head. The housing market was way too hot in 2021 and early 2022. And I think that 2024 will be sort of a year of transitioning towards a normal. So I think we'll have relative sales growth. I think we'll see house prices moderate towards a more long-term historic average. And so we'll see some improvement, but I don't don't necessarily expect it to be a banner year. We still have, 90% of homeowners are locked into rates below 6%. So that's a huge lock-in effect on the housing market. So even if rates fall to 6.2, you still have a bunch of homeowners that are locked into their homes and maybe unlikely to sell. And so that'll still sort of hold the market back next year, but we should see some relative improvement. Over the longer term, as I mentioned, 5 years, we still have robust millennial demand on the sidelines. Builders have been picking up the pace in construction. There's still more homes, single family homes under construction than there were pre-pandemic. So we'll see some of those homes come to market, which should help alleviate the supply shortage. And so we should get some help on the supply side.
But there will still be some shortage, I'm
Oh,
sure.
yes. I mean, the shortage right now, if you look at estimates from, all over the industry, it really ranges between like 2.5 to 5 million. And there's 2 million homes under construction. So if all of those came to market tomorrow, it still wouldn't be enough to meet the demand. And so it's still a housing shortage in the years to come relative to demand.
So bottom line, keep building more, single family and multifamily.
Yes,
I love that. Well, as our conversation draws to a close, I have a couple more personal questions to ask.
Okay.
So it's always intriguing to think about the path we choose in life. Mm-hmm. And just out of curiosity, if you hadn't found your way into economics, especially in single family housing or real estate economics, what other profession do you think you might have been drawn to? I mean, was there even a secret passion or maybe a childhood dream you thought about pursuing?
Yes, it's an easy one. I wanted to be an astrophysicist. I have an uncle that was an astronomer and majored in astrophysics. So I would read and consume tons of books on the topic. So I was very interested in Albania and here. It was a big passion of mine and always something I was interested in. But I'm lucky. I made a good choice. I'm happy with where I'm at. But I still sort of read up on the topic on my spare time.
I mean, if you had decided to go that way, we wouldn't have to deal with forecasting. And that's depressing.
Yeah, we would not have to deal with forecasting, but it has its own share of challenges.
Absolutely.
For sure.
Absolutely. That's fascinating. Now, success can mean different things to different people, and especially in a field as diverse as economics. Now, how do you personally define success in your career? And for those just starting out in economics, real estate economics or automotive economics, what advice would you give them on setting and achieving their professional goals? As we said in the beginning, having a mentor means a lot in life.
Yeah. So your first question, and how do I define success? I think, we're economists. We're trying to research and get our research out there in a way that makes sense to people and that hopefully shifts their perspective and makes them understand perhaps what is a difficult concept to understand. So my best achievements in the industry is when someone comes up to me after a presentation and says, wow, that made sense. I have some clarity on that topic. Those are sort of my proudest moments, I think, at this job is when I hear that from someone who listens to our research. And so I'm hoping that we can make a difference. I'm hoping that we're getting our research out there and teaching people something that they maybe didn't know.
You'll get one of those moments after this podcast.
You better. No. And the advice is, I'm going to copy Thomas Edison here. I think it was Thomas Edison who said, there's no substitute for hard work. I'm a big fan of continuing education, never being complacent in what you know. Economics is such an ever evolving field. New methods, new econometric techniques. It can be overwhelming, but it's also so rewarding to be in an industry where, you have one programming language you knew, and now you're shifting to another one. And, the theories are changing or they're not behaving as maybe we knew them to behave. I'm looking at you, Phillips curve, but, it's so robust of a field, and, it's really a field where you can just continue to learn and grow and never be complacent in what you know. So just make sure to stay up on your continuing education. That would be my advice. And always over prepare if you need to.
I agree. Odeta, this conversation has been incredibly enjoyable and insightful. Now, we've managed to cover a wide array of topics in these 40 to 45 minutes, yet there's still so much ground to cover and explore. So I'm hopeful that we'll have the chance to continue this wonderful discussion in another episode, perhaps next year.
I hope so. I really hope so. Faleminderit, thank you so much for having me.
Thanks for joining us for another episode of Multifamily Talks, a RealPage podcast. As always, the views expressed are those of the individuals participating and not those of RealPage.